All right, here we go. 3, 2, 1. Happy Sunday, everyone. Welcome back to Merlin's Pod. Today, I'm reviewing Jay Powell's report on the financial stability in the U.S. markets along with the Federal Reserve. The report in total is about 68 pages long, and I will be providing a quick summarized version of it. If you want to go read the actual report, it is available on the Federal Reserve site. And it was released last Friday at 4 p.m. after the markets closed. Now, I first want to start with what is the purpose of these reports. The whole point of this report is to promote public understanding, increase transparency, and accountability within the Federal Reserve. They decided to measure stability in 4 standards of vulnerability: valuation pressures, borrowing by businesses and households, leverage within the financial sectors, funding risks. These vulnerabilities often feed off of each other and interact with each other as well. So what do they find? And it's kind of interesting right here. So what they decided to do was they kind of have changed their tune in a very interesting way. Since this is pretty much the first full report we've gotten on the market since, I want to say, back in December 2019 by the Federal Reserve. And what they decided to do in their summarized view is essentially that most market sectors are under high vulnerable risk and are potentially exposed to significant asset price declines. So that actually leads us into our first part, asset valuations. What they said was that asset prices, stocks and bonds, have been volatile across many markets. Since their lows in late March and early April, risky asset prices have risen and spreads have narrowed in key markets. Now, what they're saying right there is that despite them having high risk, the prices have still increased. So that can include stock prices, bond prices, as well as real estate prices, and there's a few other sectors that we can go into, but I think the main focus for the people that are actually listening to me are that stock prices, even though they've been quite volatile, have risen over time, and the Fed is a little skeptical of this. And we know that they're skeptical of it because what they say in the next part is that they're still highly vulnerable to significant price declines. And they try to temper it a little bit with the next statement, which is what they say right here, is that should the pandemic take an unexpected course, the economic fallout prove more adverse, or financial system strains reemerge. Now, to me, it's a little bit funny, right? Because basically what they're saying is, well, as long as things don't keep getting worse, we're probably okay. And I don't know if you've looked around recently, but it doesn't appear like most things are getting better, especially with the increased new threat of a Chinese war, or at the very least a Chinese trade war. I don't really think a hot war would actually be necessarily realistic in thinking about it. But I do think it's very realistic that we're going to enter into a trade war with China very shortly. And that means that a lot of the asset prices that we've decided to value at X dollars probably means that they're currently overvalued, and that's what the Fed's trying to get at. Now, on to the second standard, borrowing by businesses and households. What they found was that debt owed by businesses had been historically high relative to gross domestic product through the beginning of 2020. So what are they saying? What they're saying is that debt has decided to balloon for both businesses and households. And it's concerning because of the significant drops in revenues as well as the severe reduction in economic activity, which is kind of funny because of the temper that they just set, which is they're like, well, as long as the economic fallout doesn't prove more adverse, and then they go in to say in their next piece that the economic fallout is really bad. And maybe I'm reading too much into it, but that's what my takeaway from it was. Now, they believe the ability for debt repayment is significantly strained at the moment. As a result, lenders have drastically repriced their credit risks to more aptly suit the now increased amount of risk from borrowers. This means they are jacking up credit prices and becoming more picky with their lending. And this can cause potentially a liquidity problem as well as a very clear solvency problem within the market. And when I say solvency, I mean the ability for households as well as some businesses to repay their debts if they don't have cash flow. There isn't cash flow necessarily happening in households within the market at the current moment. Now, to get into the leverage in the financial sector, which is the third standard, before the pandemic, the largest U.S. banks were strongly capitalized, and leverage at broker-dealers was low. By contrast, measures of leverage at life insurance companies and hedge funds were at the higher ends of their ranges over the past decade. So what are they saying? They're saying that banks right now are pretty okay, but there's other lenders and other sectors that are significant within the financial sector that are actually exposed. So even though a lot of what was fixed in the 2007 to 2009 financial crisis was fixed, a lot of it actually wasn't. And a lot of it is now starting to reemerge as a new issue, and the Fed has decided to highlight this issue. They haven't decided how they're going to attack the issue. In fact, they might not even attack the issue. I'm sure, as Jay has kind of alluded to back, if you watched his Wednesday conference last week, what he was saying was that, the Fed has opened up their lending facilities, but now it's really on Congress to provide better funding, better bills, and to provide the actual fix to this kind of stuff. As far as we know, what we heard on Friday was that even though the initial stimulus checks passed in the House, it was supposed to be dead on arrival to the Senate floor, which means that basically the Senate wasn't going to agree to the terms discussed in the House, but the House decided to pass it anyways. Now moving on to Standard 4, funding risks. In the face of the COVID-19 outbreak and associated financial markets turmoil, funding markets proved less fragile than the 2007-09 financial crisis. Nonetheless, significant strains have emerged, and emergency Federal Reserve actions were required to stabilize short-term funding markets. The outlook for the pandemic and economic activity is uncertain. In the near term, risks associated with the course of COVID-19 and its effect on the U.S. and global economies remain high. In addition, there is potential for stresses to interact with pre-existing vulnerabilities stemming from financial system or fiscal weaknesses in Europe, China, and emerging market economies, EMEs. These risks have the potential to interact with the vulnerabilities identified in this report and pose additional risks to the U.S. financial system. Now, what are they saying? They're saying that we could go to the full extreme. What the Fed is saying is we're fucked, basically. No, I'm just kidding. So the Fed is saying that there are high amounts of vulnerabilities within the current stock market. And basically, we really need a miracle and for nothing else to go wrong at the current moment. Because if anything else goes wrong, there's a whole bunch of strain going on throughout the market, from whether it's households facing a solvency crisis to asset prices being highly overvalued. There's a potential for a stock market crash and then huge financial turmoil to pursue. Now they're saying, though, on the bright side, as long as anything doesn't go wrong, doesn't continue to go wrong, we should be okay. But to me, this is a significant shift in the Fed's temperament. The Fed at the start of February believed that this would only be a 2-month problem. And that's why they took such aggressive measures initially by trying to quickly liquidate, or not liquidate, but add liquidity. Liquidity? Yeah, to add liquidity to the market. All right, guys, that's pretty much the overview for the Federal Financial Report, Stability Report. If you like this podcast, make sure to like and subscribe to the channel. Yesterday, I also released the short version of Merlin's pod, which covers my weekly stock picks as well as the news pushing us into the next week. So make sure to give that a listen, a like, and a subscribe. Well, if you've already subscribed to the channel, you're good. So anyways, guys, have a great day. Talk to you later. Bye.